everyone. My name is Rabia Athar. I'm one of the co-founders of HerCapital. Thank you for joining us for the HerCapital Aspiriant Personal Finance Series, Part 3. For those of you that have not joined us before, this is a series of events on personal finance and investing. We are joined by esteemed speakers from Aspiriant, which is a wealth management firm based in California. If you haven't watched the prior sessions, I would highly encourage you to either stop here or watch this session and then go back and look at part 1 and part 2, both of which go over basics of personal finance and investing, and I'm sure you'll find it extremely useful. For background, if you're new here, my name is Rabia Athar. I'm one of the co-founders of HerCapital, and I'm joined by my co-founder, Zabreen Khan. My background in finance is that I work at a sell-side bank focused on institutional investing for large asset managers in the US. And Zabreen, why don't you quickly introduce yourself as well before we get started?
Perfect. Thank you, Rabia, and welcome everyone. If you have joined us for previous events, welcome back. And if you're new here, welcome. We're so excited to have you and to share this conversation with you. A little more background on myself, as Rabia mentioned, I'm one of the co-founders of HerCapital. Outside of HerCapital, I work as a technology investor in New York City at a growth equity and venture capital firm. We invest in software and internet businesses. And prior to being in the investing world, I didn't know much about investing. I worked in tech. And so these were topics that were very new to me. And I was really searching for a place where I could go and learn about investing, learn about how to manage my money. And Rabia and I actually realized this is a problem that many women our age and older and younger are facing. And so that's actually how we started HerCapital, which, again, if you're new here, is a community organization and a nonprofit empowering women on any topic around personal finance and investing. And we do so through events like this one, as well as through our website, which contains an online knowledge base, and our social media platforms. So definitely check us out if you haven't already, and we're very excited to get this conversation going. I'd also like to turn it over to Elizabeth and Katie, who lead our programming team. Do you quickly want to introduce yourselves?
Sure. I'm Elizabeth. I'm a sophomore at Harvard studying economics and computer science.
Hi, my name is Katie, and I'm currently a sophomore at the Wharton School at Penn studying finance and business analytics. I'll pass it back to Rabia.
Awesome. Thank you, guys. So as I mentioned earlier, we're joined by two amazing speakers from Aspiriant, Lydia and Lorraine. And if you haven't joined us before, I'm going to quickly let Lydia and Lorraine both introduce themselves before we get started for the session today. Lydia?
Hi. Yes, I'm Lydia Waltz. I have worked with Lorraine at Aspiriant now for about 3 years. I earned my bachelor's in history at Bryn Mawr College in 2016, and then I came to work in personal finance, first at a small branch of LPL Financial, and then I transitioned to Aspiriant to do more hands-on planning work with clients. While I work in financial planning, and investment management, my passion is in financial literacy. So doing series like this with HerCapital is something that brings me a ton of fulfillment. Thank you, ladies, for making this possible.
We love hearing that. And honestly, it's been such a pleasure having both of you on, and you guys have been extremely helpful. So we really appreciate it. Lorraine.
Hi, I'm Lorraine Fox. I'm a partner at Aspiriant, which is one of the largest independent wealth management firms in the country. Prior, I've also worked in other areas of finance. I was a general partner in a venture capital firm. I also had a background in technology. I was a leader in marketing for both startups and large companies. So I also am so passionate about personal finance just from my own experience and trying to learn on my own after being fortunate enough to be at a company that experienced an IPO. It was very, very difficult for me to seek advice as a young woman. And that really made me want to learn as much as I could and to teach that learning to other people. So education is empowerment. And that's one thing we love about HerCapital.
Amazing. Thank you both for being here today and for helping us with this series. I think it's been really a pleasure. With that, let's talk about the agenda today. So as the title of this series or of this particular part suggests, we're going to be speaking about two topics. Number one is behavioral finance, which is kind of a term that's thrown around a lot. and people talk about it, but we want to kind of demystify the term and explain what it means, what are certain behavioral biases that impact investors, but also particularly impact women. And then the second topic we want to talk about today is macroeconomics. Again, a term that gets thrown around a lot, and people talk about macroeconomic trends and things that are happening in the economy. But really, we want to focus on demystifying and helping you understand what macroeconomics means, and then what are certain trends or themes to be mindful of in this environment, which has been particularly challenging for, professional and personal investors alike. And so those are the two main themes we'll be talking about today. We also want this to be a discussion, so you'll be hearing from the team members that we have on today, so Zabreen, myself, and Elizabeth and Katie, as Lorraine and Lydia go through the materials that we have prepared today. So with that, maybe we move on to the next slide, and then Lydia, I know you wanted to explain a little bit about kind of behavioral finance, so I'll hand it over to you.
Great. So we know that the economy can affect the market, and we're going to look into that. As Rabia said, it's important to understand macroeconomic trends and how the market will shift and display itself among them. But one thing that you should really keep in mind that is important is the emotions and the biases that we bring with us when we are investing our money. It's emotional. You earn this money. This is your money. This also displays the goals that you have and your ability to achieve them. So keeping in mind some of the biases that you might have when you're investing is important. So we'll go through a few of them. I also want to mention that if you're interested in this topic and you want to learn more about it, I would really recommend Daniel Kahneman's Thinking Fast and Slow. He's a Nobel Prize winner on this topic, and he is really one of the key people who brought to light that we are all human. We are human investors, and how we invest in the markets is reflected both by our thoughts and feelings, as well as understanding and researching and looking into the market. So what biases should you be aware of? So we'll outline, overconfidence. Most of these words are going to mean something to you already. Overconfidence is overstating one's ability to pick a great stock or, make a precise determination of where something's going to be. Maybe it's overconfidence in the research you've done. Perhaps it's just thinking that you know everything. But then there's also the herd mentality, and these things blend together. Perhaps there's one very overconfident person who's driving the herd that's following, and one person's confidence can really lead other people to sort of say, hey, that person seems to know what they're talking about. I'm going to go do the same thing independent of my own research. And then FOMO needs no introduction. That fear that, hey, somebody else is doing something that I'm not. Should I be getting in on that? And perhaps making a quick decision rather than an informed one, just because you have that fear of missing out. So Lorraine, do you want to take it away with some of these behavioral risks?
Yeah, these again are everyone has biases. We hear a lot about bias in the workplace, unconscious bias, etc. But the same types of biases exist when one is trying to evaluate investments. So framing is a very important one to know. And this means that you have an idea that an investment is good or bad, and it's very difficult to assess investments that way. Investments should be assessed based on, price earnings multiples and ability to grow, etc. So there is no such thing as a good investment or a bad investment. It's, will this investment help you meet your goal and add to your diversified portfolio or not? So we would discourage someone from framing any kind of investment as good or bad. Depending on what your goals are, there may be a type of investment that has a purpose in one portfolio, but maybe not in another portfolio. Confirmation bias is also taking one's personal belief and saying that whenever you assess information, it will confirm your belief about something. So say you think someone is nice, and then all of their actions you view from that lens. Oh, that was because this person is nice, then every single action that that person does is also nice. And that may or may not be the case, right? But it's just your confirmation bias going into it. And then there's home country bias, which is really important, and we see this all the time. I live in the United States. I know the US, therefore I'm going to put all my equity investments in the S&P 500. That in and of itself indicates a bias where someone should be looking more globally at opportunities. Lydia, we want to take this one?
Sure, yeah. So recency bias, this is a great one, and I think very appropriate right now, having just come off of some of the downturn that we saw in COVID and the market upswing. So recency bias is simply confirmation that you give yourself based on something that just happened. We have to recognize and remember, we don't have a crystal ball. It's not necessarily so that history is going to repeat itself in the future. So recency bias is just expecting the same thing to happen simply because you saw a similar pattern before. Hindsight, it's also very similar to recency bias. These things are very close together, and we have to recognize and remember that we're not ever going to be just one single column of things. We can always have many elements and many biases that are kind of coming together and being informed in different ways. Anchoring, another amazing one that we definitely see a lot in the professional field. An instance of this is saying, oh, I bought a stock at $45 and then it went down. I'm going to wait until it gets to $45 again before I sell, or 46, 47. And so now I'm anchored at 45, regardless of any research I might do about what the company is doing, what the stock is worth. I'm saying, no, I'm holding out for 45 or above simply because that's what I bought it at. You have to, just to round that out, just remember that you have to be informed. You have to do your research about these, about how you choose to invest and what asset classes you choose to invest. And one of the best ways to avoid some of these biases is to make sure that you're truly diversified. You might be biased against some of the diversification methods, but that doesn't mean that they're going to do poorly or do better simply because you have those biases. So diversification is one of the best ways to get through this. I think we've all experienced some of these in our life.
One of the comments I wanted to make, Lydia, especially the first behavioral risk that you touched on, was overconfidence. And I think oftentimes as women, we experience the opposite of that. We experience underconfidence. And I know we've touched on this in some of our previous events and panels. And one of the things we talk about here at HerCapital is that women may be underconfident because we aren't taught personal finance. We aren't taught how to invest, and there's often an overload of information. We don't know how to sift through it. And so we just hesitate to even start and take those first steps. But actually, when we start learning about it, we tend to, take all the knowledge, make a very educated and informed decision. And then women's portfolios often perform better than men's. And so that's something that I just wanted to add, that I thought about when you mentioned overconfidence. And then the second point I wanted to make, you touched on diversification at the end. And if you haven't yet, tuned into part 1 or part 2, Lydia and Lorraine do a great job of talking about diversification. So definitely take a look back at those if you need a refresher, or if you'd like that term clarified and want to better understand how to diversify your portfolio.
Yeah. I think, I think these are all extremely valid points. I think one other thing to keep in mind, and I think Lorraine mentioned this, is these are just some of the biases that we have, but really the point of highlighting these is to make you aware of the fact that these behavioral biases exist, and that so many of us are doing these, kind of non-scientific or bad decision-making, using these bad decision-making tools that are detrimental to our own financial health. So to Lydia's point, I think, anchoring is a perfect example, or, hindsight trading is a good example, or recency bias is an amazing example, or underconfidence or overconfidence or FOMO. Like, all of these are things that we do without actually realizing the impact that they can have on your investment portfolio. So hopefully by highlighting these, we are making you more aware of the fact that these exist, and hopefully you can start checking yourself every time you are falling prey to some of these, at least.
And it's completely normal. I'm a woman in the field, and I'm still totally prey to underconfidence and herd mentality. Absolutely. If I hear somebody say, oh, I went and bought XYZ, I'm thinking to myself, maybe I should do that too. I have FOMO and I believe in their confidence. I'm ready to follow. But of course, I check myself and I do the research.
And a question that I had on my mind was, given these risks, which ones do you think we should look out for the most? And in particular, do you have any insights unique to our COVID-affected environment?
Lorraine, do you want to speak to this?
Yeah, so let me address the questions in that order. So I think fear of missing out and herd mentality are two biases that all of us are subject to. I mean, we're all influenced by people around us. So I've seen this in a company where, say, they just had an IPO, for instance, and employees are all talking amongst themselves, and one will say, I'm not going to sell my stock until it reaches this price, and then the other people are like, oh, that person must know what they're talking about, so I'm going to follow his advice rather than thinking what is the right decision for myself. So I think that's something that I've seen a lot that occurs in companies, frankly. In terms of COVID and its effect on the economy and just making investment decisions, I think it's been very, very difficult. There's also herd mentality. I mean, there's been a lot of instances of fear, right? Where we don't know much about this virus. We don't know what the impact is going to be. Unemployment is really extreme. And then people will all of a sudden become exuberant. Oh my God, we have a vaccine. The market, stocks go up 3%, 5% in a day. So we've seen this kind of swinging back and forth with COVID. But I think one thing that I would recommend for people is really just bring it down to the most basic levels. How much can you afford to lose when you invest? Manage risk and return very, very closely. And also just manage your cash flow. That's not an investing tip, but it's just a personal finance tip, because things have been very, very uncertain. And we've also, undergone an election cycle too. So, but this pandemic is very, very serious, and there will be effects, long-lasting effects to the economy. I mean, unemployment is very, very high right now. Okay.
Thank you so much for your insight.
Great.
Awesome. So I think what we can do before we quickly jump into the macroeconomics section is, if you guys have any thoughts or insights on how some of our audience can avoid these behavioral risks. So any tips or tricks that maybe you use yourselves. I was trying to think of what I do, and I think the number one thing, and I know, Lydia, this is probably your favorite thing to say, is don't step away from your research. So if you have made up your mind about something or decided to make an investment because of X, Y, or Z reasons, every time you're feeling FOMO, or every time you're feeling like you're following someone who you think is smarter than you or seems more confident than you, go back to those reasons and that X, Y, or Z and see if those reasons are still valid. And if they are, that should be governing your decision, not your feelings per se. But any other tips or tricks that you guys like to use or that you'd recommend before we jump into macroeconomics?
Absolutely. Yeah, no, you go ahead, Lorraine.
Oh, sorry. One thing that I was going to say, and then Lydia, please share your thoughts, is that I think someone has to be aware of her goals. So if my goal is to continue to invest, to have enough eventually for retirement, if it's I want to, invest so that I can make a down payment on a condo, something like that, then you have to make sure that any investment decisions that you make are going to help you meet those goals. So even though someone is saying like, oh, Tesla's a great investment at, $600 a share or $1,000 a share, it may not be the right thing for you to do. It has to all relate back to you, to your goals.
This is something that completely blew my mind when I first started working with Lorraine and at Aspiriant. It had never been framed for me that a goal should be paramount to investment. Rather, it was grow the money. And
this is the problem. It's like the first step that you have to take is the step that no one talks about, which is goal setting. And again, I will plug part 1 and part 2 of this series again. Lorraine and Lydia talk about setting financial goals and thinking about how to even make that financial plan in part 1. And so if you haven't, please go back and watch that. To get some insights on how to even think about those questions. But yeah, I mean, Lydia, I couldn't agree more. I think like up until I would say 3 or 4 years ago, I had no conception of setting financial goals, and investing was all about kind of making money and in a vacuum, right? And which is not how it is at all.
Yeah, it's definitely not about, oh, I made more money than, one of my colleagues or something like that. That may or may not be important given your goals and your colleagues' goals.
Mm-hmm. Absolutely. And so another thing that I touched on a little bit before, but I just really do want to emphasize is the importance of diversification. Biases can be so well managed when you are widely invested. And of course, as Rabia said, making sure that you're doing your research on the asset classes that you're investing in and what funds you're investing in, or what mechanisms you're using for your investing. And we do go over that in a previous session where it's just, how do I get started? What do I choose? Where do I go to look? Morningstar is usually a good one. There's Investopedia. There's plenty of great resources out there to do research. It's not like you need to have big spreadsheets for everything. It's very easy to intake. And so then I would just also say, I do this for a living. I do this for other people. I do not do it for myself. I use a robo-advisor. I find that my biases are too hard, and I spend all day checking other people's money. How am I not going to be clicking into my own? And so it depends on the kind of person you are. I recognize that when it comes to my own, I have too much wrapped up in it. When I'm thinking for somebody else, I am able to be much more objective. So you might look into a robo-advisor if you feel like if it's either doing the research is going to take up too much of your time, or the biases are going to be too difficult to overcome.
I love that. So if there's 3 takeaways from this section before we move on to the next one, I have one, which I think is really important, Lorraine, so thank you for pointing that out, is set your goals and stick to that. 2, which I mentioned, and I borrowed it from Lydia, so I'll give her credit, is do your research and make sure that your decisions are determined by your research and not by these biases. And then 3, which I think is another really important point, Lydia, is know yourself. So know if you have the capacity to do that research and to overcome these biases, or if you think you can't, then you can go to a robo-advisor, you can work with a financial planner or a wealth manager. All of those are okay, and I think great options depending on what your goals are and what you're trying to do. So hopefully that's helpful to everyone that's listening. And then with that, I think we should move on to the next section, which, as I mentioned earlier, is macroeconomics. So we'll walk you through what that even means, and then some recent trends and themes that we think are interesting and good to know about. Great.
Yes, so economic conditions and how they influence the market. Ideally, the economy and the market should move in tandem. Indeed, people use the term as though it's exchangeable. It's not. The economy is the health of the system. The market is simply the prices of the underlying shares of the companies that are partaking in the system. So you can decide, so should the economic conditions matter to the market? Yes. At the moment, we've been seeing some pretty interesting trends. Well, first, Lorraine, do you want to comment on macroeconomics?
No, keep going, and then I'll jump in
Sure.
a slide or two. Yeah.
Got it. Yeah. So recently, it's been amazing to watch as the gains of just a few companies have driven the market higher and higher, while many of the other companies, and we're exhibiting home bias in this, we're going to use the S&P 500 for as an example. But so in the S&P 500, there are 500 companies. 6 of those companies have been driving a majority of the gains that we've seen in the entire index. And we think that's pretty crazy. And so what we're seeing here is that it's the Super 6, the Facebook, Amazon, Apple, Netflix, Google, and Microsoft have been able to account for 25% of the S&P 500's price, while the other 494 companies account for just 17% of the rise in the price over the past 5 years, which is just remarkable to us.
Yeah, I mean, if 6 companies are doing really, really well and accounting for almost a quarter of the gains, that means 494 companies are not doing that well. You know, just so you can think about it in that perspective as well, is that, you know, 6 companies should not be driving an entire index. Lydia, back to you.
No, I'm interested. Elizabeth, do you have a question for us?
Yeah, so just looking at this, it makes me think this is a pretty significant macroeconomic trend, but then what does that mean for personal investing? How do we look at the S&P? How do we look at these 6 companies? How do we look at companies that will eventually be these 6 companies? Would love your thoughts on that.
Of course. Lorraine, do you want to pick this one?
Yeah, so first of all, we would want to look at it on an index level too. So yes, it may or may not be impossible to identify the next 6 companies that will experience this kind of growth. But if you have broad exposure to these companies through an index, either NASDAQ or S&P 500, then you can get exposure over time without also putting a lot of individual risk in a particular stock holding. So you always want to be managing risk and return too along the same time. But really, I mean, there should be kind of a yellow flag alarm bells going off about when you look at an index and not all the participants are doing well, but only a few are. That may indicate that not having overexposure to that index would make sense. You know, that gains will occur elsewhere, maybe in international, maybe in small cap, maybe in emerging markets. There are other areas within the global economy where one could grow.
That makes sense.
And I think just to piggyback on that, I think an interesting takeaway there would be that, you know, if we've seen a ton of growth in just a few companies, what does that mean for what we can expect going forward? And one thing that we might keep in mind is that if there's been a lot of growth, how much more room is there to grow? So in the years following, in the years to come, should we expect the same level of growth as we've seen in the last few years? Perhaps not. Perhaps we should be ready for things to slow down a little bit.
And that circles back to the hindsight point of, you know, what just happened doesn't mean it's going to happen in the future as well.
Exactly. Don't be too informed by what has happened. So I think from here, we'll let Lorraine take the next slide and talk a bit about some important systematic pieces of, I hate to say systematic pieces of our system, but some important integral pieces of our system that you should keep in mind when you're investing.
Yeah, and the reason we wanted to bring this up is because, you know, these topics are in the news all the time, particularly as we've just gone through an election cycle, and there's a lot more focus, I think, in the news about the, you know, deficit spending. What does it mean? Tax policies, things like that. And, you know, all these will have an impact on the economy. So we just wanted you to be aware of what it meant. So first of all, the federal government is mainly facilitates transfer payments. So they bring in revenue from both taxes and the sale of government bonds. And in the same time, they transfer payments out to both individuals and states and municipalities. So what does that mean? I mean, you have to bring in money in order to pay it out. And if not, your deficit will just accumulate. The deficit is what the annual difference between revenues and expenses at the federal level are. Government spending falls into 12 different categories, but the three largest are Social Security, national defense, and then income security or welfare. So those transfer payments go out to individuals and also to protect the country. But, a big imbalance can occur and is continuing to occur ever since we went through the global financial crisis in 2008, 2009. So if we look at the next slide, this slide is pretty difficult to read, but it basically just is a way of explaining what I just said, that the national government has been operating at a deficit. So it's been spending more than it's been taking in since 2008, 2009. The deficit this year, again, we've made a lot of transfer payments out to both individuals and businesses. And from what I understand, Congress is getting closer to passing another stimulus bill, which will help both individuals and small businesses. But, there's a huge deficit of 3.7 trillion this year in 2020. Another reason that revenues are not as robust as they had been in the past is because corporate tax levels have declined considerably. So that doesn't contribute much in terms of revenues to the national budget. We'll see what happens with tax rates going forward with a Biden-Harris administration. But, if you look at this, you can't go on like this forever. You can't just keep, the federal government will never go bankrupt, but there are things that they need to do to bring things more into balance.
And I think, Lorraine, I'll stop you there. And I think this is the question that sort of everyone is asking. But given this state of, or the magnitude of the deficit that we have now, what do you think happens? I mean, if we all kind of agree in principle that it should not go on at this magnitude, but what types of assets would get impacted? Or if I'm looking at a personal portfolio, what are the risks given that we now have this information?
Yeah. So one thing is the Fed has stated, and again stated today, they're going to keep interest rates low in order to help stimulate the economy going forward. So, if they raise interest rates and banks raise interest rates, then, businesses, it costs more to borrow basically for both businesses and individuals. And since both businesses and individuals have been impacted by this pandemic, keeping interest rates as low as possible should help the economy get back on its feet. However, that also means that if you are investing in bonds, particularly treasury bonds or even municipal bonds for that matter, the yield on those bonds, like the interest income that one can generate from fixed income, is low and a lot lower than it has been like on a long-term average. So that could impact a portfolio and actually drive investors to other parts of the economy to try to get a return. That return, would come from equities, either domestic or international, because you can get more yield off dividends than you can off interest income from bonds.
And that's really an interesting point right now, is because people go to bonds usually as sort of the safe thing that is not volatile. And so if we're thinking just about risk tolerance and how much risk we're willing to take on, if you aren't a terribly risky person, or if your goal is saying, hey, that goal is coming up, make sure that you're not taking on too much risk in here so that you have the money there. And bonds aren't really going to help you meet that goal anymore. And you have to look to equities, which are more volatile. You're taking on more risk in that portfolio to generate a return. And so that is something, there's a trade-off there that you're going to need to consider.
Yeah, I mean, again, when bonds are, the yield on bonds is as low as it is right now, it will drive people to equities, and that will consequently cause equity markets to rise, regardless of the fundamentals.
Yeah, and Lorraine, that's something that's being written about too, right? Like
Yeah.
the idea of the fact that equities have been rallying the way that they have, I mean, over this pandemic.
There's nowhere else to go.
Yeah, equities tend to look into the future, but yeah, to your point, there's nowhere else to go. So thinking about, how long this goes on, again, if rates stay low, there's a likelihood that, we continue to see people remain invested in equities because there's nothing else to do. That's an extremely important point.
That's right. And, federal policy on interest rates, it's whatever they do is going to have to be super gradual because, again, we have to see if the economy can withstand higher rates at all. Let me just touch on this for a second too. We mentioned that Social Security was one of the largest transfer payments that the federal government makes. But again, given that we have an aging society in the United States, Social Security transfer payments have been increasing over time, just in volume. There are, cost of living increases that people get as well. But given that we have an aging demographic, Social Security reserves are expected to be depleted by 2035. Now, there are things that the government can do to right the ship, but, you have to start now. Same with Medicare. I mean, those reserves are expected to turn negative in 2029. And yet all of us, when you look at your paychecks, we have deductions for both Social Security and Medicare that, are there to help us in the future. But at any rate, we could contribute more to those areas, but, we're going to have to eventually pay the piper at some point. That brings us up to the national debt. It's quadrupled in less than 20 years. Now, we do have diverse ownership of our debt. It's not all owned domestically. We have foreign governments that own some of our debt. But if we do experience some inflation and try to inflate our way out of this debt, then that means purchasing power will decline. So we're going to have to figure out, these are complicated policies that we have to work through. And this next administration is really going to have to pay some attention to, so that we get this balance right and we don't end up triggering, currency and trade wars between ourselves and our trading partners. So the last point is a pretty interesting one that I want to make, and that is each generation tends to have their top issues that they want to be addressed. So right now, millennials are more interested in job security and climate change, but the concerns of previous generations will also influence policy. So somehow the government has to balance, what each generation wants and needs. But what's interesting about millennials, for instance, is that it's a largely they vote Democratic, and they also, like we said, are more interested in areas of job security and climate change. So if that probably will mean that we'll see some policies that will address those issues, and they need to, frankly. I mean, we can't keep the same policies that we have now without doing continued damage to climate and the environment. So there's going to be a lot of things that need to be changed. Some of these will provide growth for the economy, and that's being optimistic. That's what we want to see. But there are also issues that we have to address between the U.S. and its trading partners to avoid these kind of currency wars that could occur at some point in the future, or deep devaluation of the dollar.
I'm curious, in particular, what can the individual investor expect moving forward, especially following the recent election and upcoming potential policy changes?
Yeah, Lydia, do you want to start and then I'll wrap it up?
Sure. Yes. I think a few things that we've heard from the Biden administration and actually seen recently in Congress is some progress towards some more stimulus, which is exciting. I mean, we need to get money into the hands of people who have been out of work for a long time, but at the expense of potentially some hindsight bias or some recency bias, we did see when the last stimulus check came out a bump in the market, and that was exciting. Investors got excited because people were going to be spending some more money, and that is something that I hope we can expect to see going forward. That there would be some optimism about getting money back into the hands of people who need to spend it. And I think there's also some considerations in the longer term that on taxes too. So we saw a large surge in the market when the Tax Cuts and Jobs Act came out, and the narrative I think has been that to increase taxes might mean to impact the market negatively. I'm not certain that that's what we're going to see. There is hope for, starting to put money towards the deficit and help a little bit with the national debt and help bolster Social Security. Those things could be positive for the economy.
Yeah, definitely. The fact that we've seen corporate tax rate tax contributions decline over time, and that has had a big impact on the national deficit. I would look to see what kind of changes are going to happen on the corporate side. I think the individual side is going to be largely protected, except for very, very, very high wage earners. So I think Biden and Harris have made a point of saying they're going to protect the middle class and try to get people back to work, and that's really important. If we don't have people working, then the economy won't grow. I hope that answered your question.
No, definitely. I was going to say too. Yeah, that was really insightful.
Yeah.
So I think just a couple of things that we could round up on here, just to make sure that we covered the important items in the macroeconomics. I think we have seen that there's an emotional bias at play here called momentum. People are seeing the growth of the S&P 500 and they want to participate in it. There is confidence in its ability to go up and up, and people really don't want to miss out. To compound this, there is what we were talking about with bonds. In our second session, we did cover how bonds work. The recap is that if you give a loan to a company or government, they will pay interest to you on that loan. Right now, the interest rates are set really low. So in order to stimulate the economy and make money cheap for the person who needs to go out and borrow some money to help make ends meet, or the company that might need to borrow that money. And so borrowing money is cheap, but owning bonds isn't very helpful because it's the interest rate being paid to you is so low. So those are some things to keep in mind when creating a diversified portfolio and making sure that you're prepared for your portfolio is prepared for the long term.
Great. So thank you all for tuning in. This was great. I thought it really broadened our discussion to bring in behavioral finance and macroeconomics to the actual to-dos that we talked about in the first two parts. This is a plug to say that if there are any additional questions, feel free to reach out to us, HerCapital, via social media. And before we wrap up, here are a few of our socials. And since this is our third and final part of this series, a huge thank you to Lydia and Lorraine for sticking it out with us and sharing their insights. This, personally for me, has been really insightful in thinking about how I'm going to embark on my personal finance journey post-college, even now. And so thank you all. Thank you for tuning in. Follow along with us and have a good one, everyone.
Thanks so much. It's been such a pleasure.
Just remember, women can do it all. Women are great investors.
Yes. Thank you.